Welcome back. In the last video, we created our transaction log where we took our transactions and we identified which accounts we were going to impact and whether we were going to increase or decrease those accounts. Next, we are going to create our journal entries, which is where we actually enter these transactions into our accounting books. In order to do that, we're going to use our transaction log as well as our chart that reminds us the natural balance, debit or credit, for each of the types of accounts, which correspond to assets, liabilities, and equity above the top, as well as stock, dividends, revenue, and expenses. Remember that once we determine the natural balance, we increase using the same sign, debit or credit, and we decrease doing the opposite. So an asset has a natural debit balance. We increase an asset account with a debit, and we decrease an asset account with a credit. All right, let's get started. In transaction number 1, when we issued stock in exchange for an investment of $10,000, we increased cash. Cash is an asset account and will increase with a debit. So I'm going to book cash, $100,000. The other account we impacted was stock. Stock has a natural credit balance, and so we increase with a credit. So we're going to credit stock for $100,000. To make that a little wider so we can see it. Okay, here we go. All right, let's make this one a little narrower so that we can see our whole thing. All right, the next one, we bought inventory for $10,000 cash. So we increased inventory by $10,000. Inventory is an asset, so to increase inventory, we will debit. So I'm going to debit inventory, $10,000. We also decreased cash. Cash is an asset, so to decrease cash, we are going to credit. So I'm going to credit cash for $10,000. Remember, when we do our journal entries, our debits must equal our credits. So that's one thing we can be checking along the way. Next, we bought equipment for $60,000 cash. Equipment is an asset, so we increase an equipment with a debit. So I'm going to put equipment in my debit for $60,000. When we purchased the equipment, we decreased cash. Cash is an asset, and we decrease assets with a credit. So I'm going to credit cash, $60,000. Transaction number 4. We purchased inventory on account. So we increased inventory with a debit. And then we also increased accounts payable. Accounts payable is a liability, and we increase a liability with a credit. Okay, our debits equal our credits. Let's move on. In transaction number 5, we increased accounts receivable. Accounts receivable is an asset, so we will increase it with a debit. That's going to be $30,000. And then we also increased revenue. Looking at our chart, we increased revenue with a credit. So I'm going to credit revenue for $30,000. We paid our employees $5,000. We decreased cash, and we decreased cash with a credit. So I'm going to put that one down here on the credit side. We also increased our expenses. We increase expense with a debit, so I'm going to put in here payroll expense. If you just put expense for now, that's totally fine as well. In transaction number 7, we're going to pay rent of $2,000. So we decreased cash, $2,000, and we know we decreased cash with a credit. So I'm going to type credit down here, 2,000. We increased expense. We increased expense with a debit. So I'm going to put rent expense. And again, if you just put expense, no big deal. Totally fine for right now. Next, we sold consulting services for $40,000. So we increased accounts receivable. Accounts receivable is an asset, so we debit. And we also increased revenue. We increased revenue with a credit. So I'll put revenue down here, and it should be 40,000, not 30,000. If I made that mistake, I would catch it, because when I check to make sure my debits equal my credits, I would see that they don't, and I'd say, oh, that's right, this should be 40,000. Easily fixed. All right, next we are buying a yacht, transaction 9. We increased equipment by 250,000. Equipment's an asset, so to increase, we debit. And we bought it on account, so we increased accounts payable, and we increased a liability with a credit. Transaction number 10, we purchased t-shirts for $1,000 on account. So we increased our expenses by $1,000, and we increased expenses with a debit. Just put expense here. You could call it t-shirt expense or some sort of employee expense. We also increased accounts payable by 1,000. We increased liabilities with a credit. So we are going to credit accounts payable. All right, we're getting close to the end. We collected cash related to transaction number 5. This is transaction 11. When we collected that cash, we collected $30,000. We increased cash. Cash is an asset, so we will increase with a debit. 30,000. And then for that same transaction, we decreased accounts receivable. Accounts receivable is an asset, and we decrease assets with a credit. All right, last one. Finally, we paid a dividend. So if we go over here, we increased dividends by 31,000. If we look at our chart, we increase a dividend with a debit. So I'm going to just put dividends for 31,000. And then when we paid our dividend, we decreased cash, and cash is an asset. We decrease assets with a credit. Okay, so those are all of our transactions. We have now put them into journal entries. In the next section, we will transfer our journal entries into T accounts.